Hi, my name's Anna Serin. I'm Director of Listings Development with the Canadian Securities Exchange, and you're joining us today as part of our Summit on Responsible Investment online series. I am joined today by Nawar Asaaldi. He is the founder and CEO of Kanata Advisors, an ESG Fintech advisory firm based in Toronto. Kanata operates at the intersection of finance, sustainability, and technology. Thank you so much for joining us today, Nawar.
Hello, Anna. It's a pleasure to be with you today.
Well, it's very exciting. So the Summit on Responsible Investment, just to give everyone a little bit of a background, is an initiative that we started last year in 2023 and carrying it online this year in 2024, is really the idea of creating thought leadership content and education, as well as highlighting some of our issuers in the space, this very fast, quick, evolving, growing space in the markets around sustainability, around sustainable investments, and around the ESG side of the space that we're seeing in all different sectors. Nawar, if you could just tell us a little bit about yourself, your journey, and what led you to create Kanata Advisors.
Sure, happy to do so. So my investment career dates back to the late 90s. If we really go back, I was a day trader back in my teens. So I've been looking in markets for a long time. But I would say for the purposes of this conversation, I think the period that's really relevant to us is the last 15 years or so, where I've been focused on the sustainable investing side, initially around 2009 or 2010. I was more in the, I would say, activist investing camp. I would take a large position in companies and engage with them around their corporate governance and their corporate strategy. And I would say that was my first entry into ESG through the venue of the G side or the governance side. Over time, I created a company around that concept of engaging with companies on their corporate governance and strategy called Semper Augustus Capital. That was in 2014. At that point, I expanded a bit further the purview of ESG issues. I integrated in my investment process to the climate and the social side to some extent. And when I say I expanded, I think it's important to highlight that for me and for a lot of sustainable investment professionals, it's a learning journey. I mean, you introduce one data point and maybe two data points, and then you try to understand how that potentially expands or shrinks your universe, whether it leads to better returns or doesn't make a difference. So I did manage that company for a number of years. And ultimately, I decided to go to the institutional space because I felt on a personal level, I wanted to drive a larger impact. I wanted to merge my passion for investing and finance with a larger portfolio. I mean, I was managing still a relatively small amount of capital for myself and a small group of investors. So when I went to the institutional space, I was able to oversee billions of dollars of capital. First with NEI Investments, which is the largest and oldest ethical investment firm in Canada, where they manage about 10 or 11 billion. I was the director of ESG Insights. And from there, I moved to the asset owner space, to Canada Post Pension Plan. I still have the poster behind me, where I was senior portfolio manager for ESG investing. And during that period, specifically when I was at Canada Post, I oversaw about $16 billion in publicly traded assets, and was focusing on decarbonization and in terms of aligning our public portfolios with net zero. And that's really, I would say, was the starting point for me to think about the creation of Kanata Advisors, because what I did notice during that period is that although Canada Post was very interested in aligning its portfolios with net zero, a lot of the underlying technologies that we needed to do so were not there. So in mainstream finance, you have Bloomberg, you have fact sets, you have risk models, you have portfolio optimization tools. On the climate and ESG side, we didn't have enough tools or sophisticated tools to do so. So I decided to make the leap to the startup space to exist in that intersection of finance, sustainability, and technology in order to help startup companies develop tools that investors can use to be better sustainable investors, as well as corporate clients who may use these technologies to manage their sustainable transformation. So anyways, that's in a nutshell the last 20 years of my journey.
That's quite the
Yeah.
nutshell, Nawar. I was thinking it's interesting that you say that you became an activist in
Yeah.
2009. So just to bring people back to what happened in 2008
Mhm.
is we had the major global financial crisis.
Yeah.
So what an interesting time to get involved in the space in that role. Was ESG and sustainable investing something that the broader market even understood?
Yeah, that's a great question. And if you go back to 2008 and you think about the financial crisis, governance was a big problem. A lot of financial institutions didn't have proper incentives, didn't have proper alignment between stakeholders. That's how I really got interested into the G side of things, because I did notice that companies and large and systematically important companies can literally blow up if they don't have proper governance, as well as risk management, which often kind of ties back into proper governance structures. So that, to me personally, was the trigger to look at governance as a way to unlock value and manage risk in companies and in my portfolio. But in terms of the ESG movement itself, it dates back to prior to the financial crisis. I mean, there was a seminal document that was published by the UN in 2004 called "Who Cares Wins," and it kind of it outlined the initial tenets of ESG investing. It's why investors need to care about the E, about the S, about the G, and how it does, how these elements help unlock value. So I was not really looking into it, or really didn't really care that much about that side of things until the financial crisis, which in a way brought to the forefront topics that were highlighted several years prior by the ESG, by the pioneers in the ESG movement.
I think it's very interesting, mentioning what happened in 2008, that really governance was perhaps the most critical part of that ESG component that was really at risk, and kind of the activism and its need for that. One question I have for you before we kind of dive into this is that I feel like there's been a shift in, as we have this conversation today in 2024 around using the word or the acronym ESG. Has that shifted recently for us in the space?
I think to some extent it did shift, and that's largely because of the anti-ESG movement in the United States. There was a lot of push around the acronym. So companies or financial institutions, they steering away to some extent from ESG, but it's really a change of label. There's nothing really changing under the hood. A lot of investors are using the term sustainable investing. If you look at corporate reporting in terms of the publication of ESG or sustainability reports, ESG and sustainability are still the two most widely used terms. So there is a shift, but I wouldn't call the shift important beyond kind of labeling exercise.
So we're still able to use it. That's good to know.
Yeah, absolutely. Yes, we can.
Okay, so what I'd love to dive into is I'd just like to know from your perspective, what are some of the key trends that we've seen? As I mentioned in the introduction, we did this event last year in person in Kelowna, and there were some very key trends that were happening within the space. What are some of the key trends that you're seeing in 2024?
Well, actually, I published earlier this year, in April this year, the Sustainable Business Compendium, which is available on Kanata Advisors website for free. There are about 150 slides on the state of sustainable business, and that includes a section on sustainable investing. And what we're seeing is that there's a so obviously we touched on the changing language around ESG and sustainability, so that's still ongoing. There is a degree, I would say, of marginal retreat within institutional investors in terms of the integration or the implementation of ESG consideration in the investment process. So to give you an order of magnitude, in 2022, we were at about 86 or 88% of asset owners integrating ESG in the investment process. And I refer to asset owners because a lot flows from there. Asset managers, in a way, try to accommodate what asset owners want. And in 2023, 80% of asset owners are integrating ESG factors. So there's been a slight decline in the number of investors integrating ESG strategies. I would say uh, a notable trend is that I think there is a growing maturity around what sustainable investing means. We're moving away from the greenwashing and the grandiose commitments, um, and investors are getting more sophisticated in the way they integrate ESG factor in the investment process. And what I mean more sophisticated is there are certain frameworks that are being integrated. There are better technologies being used to assess data and capture data and share findings. The talent, the training or the skills within financial institutions in terms of how they can integrate ESG in an additive way that adds to financial results is improving as we move forward year after year. And also the regulation has really also advanced in many countries. So we see the SEC, they came with their climate disclosure regulation. Now it's being challenged, but they finally publish a final document. Europe is moving ahead. We see the CSRD, which although it's focused on the corporate side, it has massive implications for investors as they look for comparable and validated data that they could use in their investment processes. And we see that Canada is also moving in the direction of integrating IFRS into a framework, although it's still work in progress. So we're seeing progress in terms of regulation. We're seeing an evolution of language, and we're also seeing an evolution in how investors understand and apply and ultimately manage their investment portfolios with ESG not being as an add-on, but as an integral part of the process.
I think you touched on something that's really valuable there, because I know that there's been I've had lots of internal discussions with our regulatory framework in Canada, as well as the exchange, and then I know our issuers are managing their disclosure requirements under IFRS, as you mentioned, which for those of you that don't know is basically the platform that we have created in Canada that's different than GAAP for accounting and auditing purposes. So how public companies disclose data points within their company. We use a system called IFRS, and that's where a lot of the stuff will get included into some of that data. This goes all the way from the top, all the way down to the bottom of the final investor, of how they review the data that is mandated to be disclosed for their investment purposes. This is a big shift that's happening within the markets, and this is happening in the senior markets and the junior markets. In the meantime, I feel like we're all running around scrambling, trying to adjust to the new information and how we use it. Wouldn't you say?
Yeah, I mean, this is new to a lot of people, and I think regulators are also experimenting with regulation. I mean, we see, for example, SFDR in Europe around creating sustainable investment products. They're labeled under Article 8 or Article 9. That's the kind of jargon often used. This, for example, this labeling regime, which has been used for the last 5 years or so, is evolving as well, because regulators, for example, in Europe they've realized that this is not an efficient way to guide the creation of sustainable investment products. So when you say people are scrambling, it's basically there's this Chinese saying that says, you cross the river by feeling the stones, and every stakeholder is feeling their way across this process, and sometimes you make a wrong step. So I think that's for an industry that large and so systematically important. I think that's a normal part of the process as we learn how to integrate ESG in a non-disruptive way.
And to your point, we're all crossing that river together, I think, as an ecosystem. Is there any major shifts that you think or catalysts that you think have impacted or changed the space, kind of within the recent years, whether it's geopolitical or whether it's within the markets? Has there been any catalysts that have really pushed things further?
I think the ESG industry has been challenged by, for example, the Russian-Ukrainian conflict. It's been a big challenge for this industry. And the reason for that is there are two folds. I would say, two ways to look at this. The first one is around how investors view energy and energy security, and to what extent investors should favor or disfavor the energy sector in periods of political turmoil. I mean, we did have a big reversal after a long bear market in the energy sector to some extent because of that conflict in Ukraine and the way Russian oil was taken off the market. So this challenged ESG investors to some extent to think about the short-term violent changes in the short term around certain sectors that are problematic from an environmental standpoint. The other side of this is the defense sector. Suddenly Europe, which has neglected its defense sector for a long time, is investing hundreds of billions of dollars in defense. And what does that mean for ESG investors who don't want to do harm? So I do think these events around major changes in the energy market, moral kind of quandaries around how to support or not support the defense sector have introduced challenges to sustainable and ESG investors. And each investor, in a way, is following their own logic and how they should integrate ESG in this context. I don't think we have, up to this point, an agreement that, okay, that's the way to deal with that issue. So I think this is an issue that probably deal with for the foreseeable future in terms of how to deal with these unanswered questions.
Yeah, and I think, more so than we ever have been in the history of time as far as capital markets are concerned, we have the ability, the very easy ability to invest in global markets more so than ever. So we're investing in something that's happening in a very different jurisdiction where there's very different geopolitical forces that have movement. So in a way, it's perhaps a much larger pool, but we have a lot more options as far as where we place our investment dollars. On that note, maybe we could dive in a little bit further. When you're kind of approaching various investment opportunities or you're adding to your due diligence process, what metrics or ESG data do you apply to those decisions, and where do you find those?
First, I would say that I'm not proactively investing in the markets I'm not managing money professionally for the time being, since Kanata Advisors work with companies or technology solution providers that are selling to asset managers and asset owners who are integrating ESG in their process. So I can speak about this from two perspectives. I can speak about my own experience as a portfolio manager up to 22, can speak also about how clients of my clients are actually using technology to integrate ESG and ESG factors in their investment process. So I would say the first phase of ESG investing was mostly a classification phase. This company has high carbon, this one has low carbon, this one has a diverse board, this one doesn't have a diverse board. It was relatively simplistic. We're entering a phase now where investors are, although there are these key metrics they're looking for, some of these data points are being tied back to what we mentioned, the IFRS disclosure requirement around sustainability metrics. So these are defined, they tie back to SASB, which is the Sustainability Accounting Standard Board, which was created in 2011. A lot of these metrics, which focus on financial materiality, have been integrated in that global regulation that the IFRS has created around sustainability, which is called IFRS S1 and S2. So investors are looking at these factors because they've been told that's where you need to look, because corporations are told this is when you need to disclose. We're seeing also the same thing with CSRD. CSRD is encouraging the disclosure of, in this case, it's more of a double materiality of how companies impact the environment or the world around them and how they're impacted by it. So investors, in a way, they're governed by the availability of data. So now when I say investors are looking at these data points, they're not only looking at how these data points are, but they're not using them just only as a categorization or classification tools. They're trying to understand the alpha generation potential for these points, the risk that might be associated with a company that has, for example, a high employee turnover and one that doesn't have a high employee turnover. They're trying to see if a company is committing to net zero, what does that mean from its financial from a financial standpoint? If a company is exposed to the sustainable energy transition, how can they be aligned with that transition and yet also generate returns? So we're having strategies that are a bit more nuanced. And I worked as a chief impact officer up to mid 22, in between the creation of Kanata Advisors and Canada Post, with a firm called Scope 4 Capital that was focused on climate impact. And we looked at metrics that we call avoided emission metrics, or Scope 4 emissions, which are that's the term that that it's a lot of investors are less familiar with Scope 4 than Scope 1 or 2 and 3. And Scope 4 emissions are what would be avoided if you were, for example, to invest in an electric car company and promote electric cars vis-a-vis, ICE cars or internal combustion engine cars. So metrics like this are a little bit more exotic, but they could be integrated and invest in a portfolio that is forward-looking. Are metrics that are becoming more popular within, at least I would say, within sustainable investors who are trying to move beyond the classification phase. So it is, at the end of the day, this is a very large global industry, and it operates at multiple speeds. But I would say that's the direction of travel for sustainable investing, to exit all this political kind of noise around it. It needs to actually dive deeper into integrating sustainability factors into an investment process, the same way you would integrate any other data point. I mean, at the end of the day, Anna, I'll end up with this. Sustainability data is not something you put on a pedestal. It's just data.
Right.
And data has some data matter, some other data doesn't matter. Some data points you can backtest, other you can't backtest. So the question is, it's really about how ultimately investors use data points to deliver on their fiduciary responsibilities, to manage risk and generate returns for their stakeholders. So if we just look at it from that standpoint, actually sustainability is nothing special other than just additional data points that render the investment process richer and hopefully better.
I appreciate that sentiment, not to put it on a pedestal, but figure out, what data points are important to you, and a proper way to manage those. Do you mind just touching on maybe just breaking down Scope 1, Scope 2, Scope 3, Scope 4 for us?
Yeah, so I mean, Scope 1 is just direct, company emissions. I mean, you may have a building, and that building is heated, and therefore, there are emissions that tie to that. It's everything that is directly under your control. Now, I mentioned heating. Well, Scope 2 emissions ultimately ties back to where the energy is coming. For example, to heat your building, is it produced in a coal power plant, on a gas power plant? Is it renewable energy? So that becomes what we call Scope 2 energy, or Scope 2 emissions are tied to the energy that flows into your facilities. Scope 3 is actually labeled as one category, but there are 15 subcategories with it. So it's about your upstream supply chain. It's about your downstream supply chain. It's the whole value chain, and it even includes the emissions associated with your employees and the way they come to work, the emissions associated with the products that you're selling, or the emissions that tie back to the operations of your suppliers.
So it's almost like a secondary. So you have your operations as Scope 1, kind of the ripple effect.
Exactly.
Okay.
Absolutely. So it get larger and larger, and I would say your degree of influence also dilutes. So you have direct control over your immediate emissions. So let's say you have a factory, that factory is, I mean, maybe you're using some kind of fuel, you're burning it in some kind of oven or machinery of some sort. The emissions that comes from that process are your Scope 1 emissions. But if you're buying electricity, and then that's in a way under your control, but not exactly. You can change suppliers, but you can't change the facilities where that energy is produced. And then scope 3 are all indirect emissions that you're part of. The trick or the challenge with scope 3 emissions is that your scope 3 emissions are somebody else's scope 1 emissions. So the challenge for investors is, how do you look at that? I mean, they don't want to double or triple or quadruple count the same emissions. And then finally, I'll briefly touch on scope 4 emissions. Scope 4 emissions are, this is really, in a way, it's a counterfactual. So if I have a choice between funding a natural gas plant, and then I end up funding a solar farm, then the difference between the emissions that would have come from that kind of project and the solar farm becomes my avoided emissions. I mean, there is more to it. There is something that we call a baseline or legacy emissions that this solution is replacing. I mean, if anybody is really curious about this, they could go to a website called the Crane Tool. It's free, and they can look at the avoided emissions of over 200 or 300 solutions, and it will show them what that means in terms of market share and type of solution.
I mean, it's a lot, right? It's a lot to kind of process, especially when you start getting further and further away from the original source. And a lot for investors to think about as they approach. I know that, I think what we're really seeing as a trend from us, from the exchange perspective, is, I think people are starting to make consumer decisions that are different than they used to with a sustainable approach. And now they're wanting to apply that to their investment as well. But it's trying to understand, the degree of how far this goes and what information is important. I think one of my last questions, as far as from the investment side, is just curious. I think there's a big shift when we see institutional investors approach the space versus the retail investor, and there's lots of times where they'll enter a space together at the same time, or there's lots of times that one will lead the other down the beaten path. What do you see as far as the institutional insertion into the space at this point? And we're, of course, speaking in terms of the fact that the markets have been difficult over the past while, so it's not necessarily reflective, but what has been the institutional movements you've seen?
So I kind of alluded to that briefly earlier when I said the degree of ESG integration in the institutional space is slightly, there's been a slight decrease from high 80s to low 80s on average. But again, this is highly regional. There are parts of the world where sustainability is at the forefront, where you see a steady push. Again, I mentioned Europe. But if you look at North America, there are multiple markets within North America. So there are asset owners more on the liberal side, whether California or New York, very pro ESG, very pro sustainable integration. Others maybe in Middle America are less interested, or Texas. You see that in Canada as well. I remember when I was in Canada Post pension plan, and we talked with other pension plans. I mean, no surprise, we talked to our peers in Quebec. They are more focused on sustainable investing. When I speak to my peers, or I spoke to my peers in Alberta, they were a bit more nuanced around how you integrate sustainable investing. I don't think this has changed a lot, but what I'd like to actually use this, I'd like to build on this point to touch on the retail investor, because retail investors are truly in love with sustainable investing. More than 85% of retail investors in North America and Europe are interested in sustainable investing. That was a data point that was published by Morgan Stanley Sustainable Investment Institute. More than half want to allocate more to sustainable investing. Actually, the number that really struck me was the criteria in terms of what retail investors are looking for from investing, what they would like to get out from deploying their money in the market. 90% of them, no surprise, are looking for financial returns, but 74% are looking to make an environmental impact. So I was struck by how many by the degree of interest in generating environmental impact that is coming from the retail investment side. So that obviously leads to the creation of sustainable investment products that asset managers asset managers in this case build and offer. Having said that, the number of new sustainable funds coming into the market has greatly diminished. A lot of there's still net growth in money going to ESG funds overall between fixed income and equities, but the number of new funds coming to market has diminished.
Well, and I mean, again, it's tough to tell, is that diminished just because the markets are taking a breather, so to speak? But, it's nice to hear. I think sometimes retail investors feel like they don't have a lot of impact in the greater market. So it's nice to hear that they really are the ones who are kind of leading the force and leading the way, and might create a bit of that impact, especially with something that's so important as we move forward. Okay, so what I'd like to get into last with you, Nawar, is just kind of, you obviously are very integrated and work very closely with companies that are creating technology and that are becoming catalysts in the market and creating change and developing what the market will look like. What's exciting you right now? What is exciting Kanata Advisors right now as far as what you're seeing, and maybe what is in the near future for us in the space?
So I love this question because I get to speak about my clients. But in all fairness, I'm working with some incredible founders who are building tools that I think are going to change the sustainable investing landscape. Just give you an example, one of my client companies launched a platform called Responsible Capital, which is basically an AI tool to help undertake ESG analytics. And what I mean undertake ESG analytics, so prior to tools like this, you would need a team, for example, of 5 people looking at 100 of pages to understand the sustainability profile or sustainable risk profile of a given company. Now you can use a tool like this by having a single person look at all this information and come to the same conclusions within an hour or two. So the efficiency that is coming out of AI is incredible. You can ask a single question or 100 question across a universe of 10,000 companies and get your answer in a spreadsheet in terms of, does this company have a biodiversity policy or not? Does it include water management or not? So these kind of questions that takes a lot of time are these tools are going to change the landscape and actually reduce the cost, because something we didn't talk about, that it does take between 10 and 30% in certain cases to integrate sustainability data in the investment process. It pushes the cost of product creation. So I think tools like this are going to help lower the price point. Other tools I've looked at, which I like in terms of productivity, are tools that manage the engagement process. So if you have issuers that are listening to us, they do have investors asking them about their carbon. Why can they do better in climate? How could they do better in terms of their social performance? A lot of these communications are sometimes distracting. It's coming from different directions. So there are tools. There's a tool called Tech that building an automated stewardship management tool that I wish I had when I was managing my fund at Canada Post Pension Plan, because we were using spreadsheets and trying to coordinate with different departments. Now we can do it with technology like impactive text technology in a very efficient way. And there are many other tools. I mean, the last one I will mention is a company called eCourse that created 2,000 climate scenarios that can be dynamically tested against. So if you want to align with a specific scenario coming from a specific central bank or an academic institution, you want to see how your company or fund aligns with that, you can do that today easily with tools like this. So all these tools excite me, but I do think they do have a common thread. A lot of them are thinking about how to integrate AI into the process to make it more interesting and more efficient as well, more interesting in terms of decision usefulness, but also for the process to be more seamless and better integrated with investors and corporate workflows.
I think the desire here at the end of the day, so that's very exciting to hear, and the power of AI. I think the desire from the community is digestible information that's easily accessible, and having the power of AI to take all those data points and be able to pull them all together in something that works substantially for us, as we enter the market. So that's all very exciting. Before we go, Nawar, I just wanted to reiterate some of the websites that you brought up. So first of all, there's Kanata Advisors, and it sounds like you have some collateral that's on your website that might be valuable for people as they want to take a look at that. I know that you had just published something recently. You also mentioned, was it the Crane tool?
Yeah, the Crane tool, which is a nonprofit kind of scope for avoided emission assessment tool.
Amazing. And any other websites or research points that you might advise people to go and check out?
Well, I mean, it's a bit of a self promotion, but I would like to share with your audience, because it'd be the first time I speak about it in a medium like this. As I'll be launching Kanata Q, which is basically a hub or a marketplace to connect buyers or users of climate solution software with the solution providers, because I think this space is getting very overcrowded. You don't know which carbon accounting firm to use, which ESG reporting tool to use, where to find them, how to compare them. So later this month, Kanata Advisors will be launching Kanata Q, which is a free tool for anybody looking to look for solutions. They can go in there and hopefully find a solution that could help them, or could help enable the sustainable transformation of their fund or their company or their business, because that's something I really strongly believe that technology is an important tool that could help us move further in the sustainable transformation of the global economy.
That's amazing. So make sure that you check that out. Nawar is very accessible on LinkedIn, and he posts lots of great information on there, as well as when he does podcasts or when he sits on panels. So I definitely encourage you to connect with him on LinkedIn and check out Kanata Advisors. Nawar, thank you so much for your time. You really are a thought leader and expert in the space, and really do appreciate you educating us all. So thank you again. For our audience out there, thank you for joining us. If you want more great content that was created under the Summit on Responsible Investment, it can all be found at CSC TV. And if you hit subscribe, we'll let you know the next time that we upload a new piece. So thank you again for your time, Nawar, and I hope that we get to chat again.
Thank you. It was a real pleasure.